how do you avoid capital gains tax on appreciated real property like a condo or a house?
Like a rental or your personal a place?
So let's kind of be generic and let's go across the board. So
Okay.
let's start with rental and kind of investment properties.
Well, in both cases, taxes can be avoided if somebody passes away, right? Which is probably the biggest penalty you can possibly pay. But there is a thing called a step-up basis, and so your house, whether it's your house or your rental home or condo or whatever, would get stepped up in value to the current value at the date that whoever it is was one of the owners dies.
Hmm.
So it could be your spouse, you and your spouse own this house or what have you, and the house would then get stepped up. You might have paid, very little for it compared to what it's worth now, but and so it wipes out the whole capital gain. If you had to sell it right then, you could do so without the big tax hit. So, um, and then if it's commercial property like a rental or what have you, there's
You,
a lot more options.
yeah, you can do a 1031 exchange where you kind of sell that property and you just buy another. So essentially, you're not you're not eliminating capital gains, but you're basically deferring it to another sale.
Right.
And then and the end goal when you ever defer is step up is the
Yeah.
basically you keep deferring until you get stepped up is
Right.
really what a lot of these tax laws is. So you also have 721 exchanges or up REITs, which are kind of like the idea is you sell to a REIT company, they manage the property for you, and you get REIT shares in exchange, so you don't have to actually do that active management anymore.
Yep.
Um, but the thing is, what is the purpose of the sale? Is it to get access to the investment? Are you looking for income? Because if you're looking for income, you always have those charitable remainder trusts,
Hmm.
whether it be there's charitable remainder annuity trust, you have charitable remainder um, uni trusts, and so those are ways you can get income. You get a tax deduction for whatever ways you get it, and you can have income for the rest of your life or a 20-year period.
Yeah, we've had clients take their rental properties and they're getting older and don't want to manage them anymore, but they have depreciated them down to basically zero, and so the gains would be high. So they place the property into a charitable remainder unit trust, for example, and they choose some charities that are going to get the value of that at the end, and then they set up a distribution. 6 to 10% is roughly the range I've seen. Higher you actually get a write-off for contributing this thing, but if you take more income, you get less write-off.
Yeah, so the idea is that it allows you to sell while avoiding a bulk of the capital gains. Um,
And still get some income from it, which
yeah,
is what you were getting from your rental property, and you probably weren't getting 6% from your rental property
yeah.
either.
The
Not
only
here.
problem is once at the end of this term, whatever is left goes to the charity.
That's right.
So essentially, with a rental property, if you stop renting it, you still have an asset at the end of the day.
Yeah,
You lose that asset when you use these kind of charitable remainders.
exactly. So if you have beneficiaries who you really want to have receive this property and you put it in a charitable remainder unit trust, they're not going to get it. It's all going to disappear upon your demise, and the charity then gets the remainder that's left over. So it depends on the situation. We have clients that don't have beneficiaries that they're that concerned with for whatever reason, and
Hmm.
so it works kind of well. Sometimes you got lots of different properties and you just want to take this one
Out of the
you know,
market
out of
or
the
one.
market, and so there's some reasons to do it, but yeah, there's quite a bit to talk about there in terms of what you could do.
Yeah, and I think the solution for you is a very specific based on
Mhm.
what your needs are, what your wants are, what are you trying to avoid, and what capabilities you have. And so I think for one of these questions, it's always best to talk to a professional, at least, and then your tax professional as well too.
Yeah, no kidding. Don't jump into that pool without knowing how to swim.